it's Descartes Stock Market Strategist, ACI Wealth Advisors, Process Portfolios with another Markets in Minutes update. Markets in Minutes has a look at the major areas where U.S. investors typically put their money. There's generally about 6 of those, and today we're going to look at 3 of them. The stock market in the form of the S&P 500, bond markets in the form of the 10-year Treasury, and commodities. We're going to have a look at oil and copper. So let's go ahead and move right on into it. Normally this update will come out on Sundays, but it's playoffs, NFL playoffs, so I can't bring myself to do a lot of work on Sundays while the teams are playing, but that'll be over soon. At any rate, if you'd like to learn more about me, visit DescartesStock.com/about, or you could also visit my firm site at aciwealth.com/about. And let's hop right into this. What we're looking at here is a chart of the S&P. And let me just kind of orient you very quickly. Over in the upper left-hand corner, you're going to see some crosshairs moving around. That's where my pointer is, so it might help you to follow my pointer when I'm trying to explain some things. So, kind of lay the table here. These red lines, this is what's known as a price channel, and this is just kind of an easy way to get a feeling for what the market is doing or has been doing, for the last year or year and a half or so. And then down here, this green line, this is the long-term trend line. So it's easy to see that, at this point the S&P is moving in an uptrend. And, for the last, about year or so, it's stayed pretty much within this price channel. A couple ventures up to the top, a couple ventures down on the bottom. Now, in the last edition, we saw that the S&P had become overbought. And that's just a fancy way of saying that too many investors bought too much of the market too fast and pushed prices up quickly. And so what happens in that situation is you have to have an extended period of consolidation typically, or you get a pullback. And the consolidation can be several weeks to several months. The pullbacks can be insignificant, 3-4%. They can be more significant, 7, 8, 9, 10%. Right now, what we're seeing is the S&P, since about December 8th or so, has just kind of begun consolidating. So it's just kind of banging around in here. If we continue to see consolidation, I would anticipate that we have many more weeks for it. There are not a lot of catalysts for further upside at this point in the market. On the other side of that argument, there are possibly some catalysts to spark a pullback. So my expectation is we'll maybe see some of those catalysts later on in the month once the new president takes office, and that could cause the S&P to pull back further down into this price channel. I don't really anticipate it dropping below the price channel at this point. I certainly do not anticipate it dropping below the long-term trend, barring some kind of unforeseen crisis. So we're doing okay. The overbought condition has kind of bled off a little bit. You can see that here where this red line comes up above the gold line. It's fallen back below that. So that's not necessarily a good thing or a bad thing. It just says that at least at this point, the market's begun a consolidation phase. So let's talk about bonds now, because this is pretty important for most people's portfolios. And there's some things that I want to talk about here that are fairly important. DGS1. Oops. There we go. So what we've got here is the dot plot of the yield curve, and I'm going to look at a little longer timeline because it's a little more clear for everyone. What we're seeing here is the yield, or kind of the dividend that you would get for buying the 10-year Treasury. And as you can see, it's moved up significantly since last summer, somewhere in the area of 80-90%, I think, before it began to turn back. And like the market, I think the bond market has perhaps been pushed a little too far too fast. I would anticipate some kind of pullback over the next several weeks. Certainly, if we see a stock market correction, we're going to see yields fall. If that occurs, and you're a bond investor or your portfolio is very heavy on bonds, I would encourage you to do some serious thinking about the duration of your bonds. So what that means is that if you own 10-year bonds, 20-year bonds, what's called long duration bonds, you might want to do some hard thinking about shortening that duration to perhaps 3 years, 5 years, maybe no more than 7 years, because I believe we're in a rising interest rate environment. I think that right now bonds have more risks than they have in almost a generation. So something to think about. I'm not telling you exactly what to do, but these are things you should think about if you are heavy in bonds. Let's have a look at oil. A lot of people consider oil an indicator of how well the economy is doing. or that it can have an impact on earnings, things like that. Really, that only affects energy companies. For just about every other participant in the petroleum economy, so to speak, when you have low oil prices, it acts as a tailwind. It helps producers, not oil producers, but things like plastics, manufacturers, things like that. And it also acts as a very clear tailwind to consumer spending. So I think what we're seeing here is oil's kind of banging around a little bit. I don't think we're going to see it much above 65 this year. I could be wrong, but that's kind of my view at this point. I don't think we're going to see it below 40. So as long as we see it kind of in that range, that's a positive in general for consumers. And the lower end of that range, 45, $50 a barrel, is really a significant positive for consumers moving forward. So that is also positive for the stock market. Let's have a look right now at copper. Copper is also referred to as Dr. Copper by a lot of traders because historically it correlates very well with what's happening in the economy, domestically and globally. And what we see here, if we back this out a little bit, is copper has been pretty much in a downtrend since 2011. And that reflects poor expectations of the economy, not a lot of industrial utilization versus capacity, those kind of things. But what's interesting here is we've seen a period where copper kind of consolidated or bottomed and now looks like it moves up a little bit, like it's moving up. Sometimes that will indicate more positive feelings about the economy, that the expectation is that we're going to see more growth, and copper, which is a material that's used in a tremendous amount of manufacturing and industry, is beginning to have an expectation of higher prices in the future. So all in all, a lot of these things are positive for the markets, but I would anticipate a period where we see perhaps an extended period of consolidation for several weeks yet, perhaps even a couple of months, or a pullback, and we'll see where that leads us. So let's wrap this up. Again, as always, thank you very much for participating. If you have questions, feel free to reach out. My email's right here, or you can visit me on the contact page on the site. And I'm going to wrap this up with our disclosures and my theme music. See you next time.